Hi, I'm Jarrett Davis and I was ranked as the second best performing Forex trader in the world by the Barclays Currency Traders Index. Now the reason for this video is of course to help you guys with any questions or comments that you've been posting to the videos that we upload. First of all, thank you very much for doing that. And the topic for this video is basically a general question. A lot of people look at currency pairs and prices, and the question that we've been getting quite a lot is what maintains a trend? So what keeps a currency bullish or bearish over a longer term, over a week or a month? What's the difference in factor between when it rallies and then sells off, or when it sells and then rallies, between that and when it actually rallies and stays up? What keeps it in an upward trend or a downward trend? It's a good question. Now the answer of course is fundamentally based, and effectively in a nutshell the answer is basically whatever the central bank policies is. So if a currency rallies based on good news, for example some UK data or US data or Japanese data came out really positive, those currencies would then rally, okay? However, if in the overall picture the currency is bearish, very often the market will sell it off again when it's had its little rush and it kind of will lose its appeal. When the currency rallies and stays there, generally it's for a very good reason. So for example, it's all about how it relates to interest rates. If the central bank has just announced that they're going to hike interest rates in the next 3 months, the currency will rally and it will stay there. It won't sell off, it won't come back down very far. That's the kind of thing that keeps the currency in a trend, bullish or bearish, over the long term, okay? And the longer those expectations grow, the more likely for that trend to continue. So effectively, it's all about basically the more directly it's linked to an interest rate decision, the more likely the trend is to last. The more removed from interest rates it is, so for example some GDP data that comes out better than expected, it's not really related to interest rates directly, it's kind of removed. Yeah, you'll get a rally, you'll get some movement on the currency, but essentially it's not going to affect it in a week or a month. That news is going to be forgotten and the market's going to move on to other news. So the closer it is to an interest rate decision, the more likely it is to hold that trend in place. So hope that helped, and I'll be back next video to give you guys some more answers to the questions that you're uploading.